Free cash flow. The reason this is so important is because you can't eat profits. We want to create free cash flow in your business. What is the calculation for free cash flow? It is your EBIT for the period, plus or minus the movement in working capital for the same period, plus or minus the movement in fixed assets for that period, equals free cash flow. Let's say hypothetically we had $200,000 worth of EBIT, our working capital went up $50,000, and we invested $20,000 in fixed assets. Our free cash flow is $130,000 because we've got $200,000 worth of EBIT, we subtract the increase in working capital, and we subtract the purchase of fixed assets. If it worked the other way around, where we had $200,000 worth of EBIT, but we decreased working capital by $50,000, and we sold an asset for $20,000, our free cash flow would actually be $270,000. Why is this number so important? It's designed to be a simple way to capture how much money does your business create without the reliance on working capital and also without the reliance on debt. For example, if we've got the $200,000 worth of EBIT, but we have to buy $150,000 worth of stock, that's going to come away from the cash we have available within our business. On the fixed asset side, what you would have noticed is we don't talk about debt. So I could buy a brand new truck for $250,000 all with debt, completely afford it, but that comes off as a negative $250,000 straight away. So in some businesses, this might be an unfair metric from time to time or on an ongoing basis, because you're always going to feel depressed because you have to rely on debt to reinvest back into the business. But that is why this number is so important, is if you have a business where you don't necessarily need to reinvest as heavily into fixed assets and you can manage your working capital, that is a business that's going to create quite a significant amount of free cash flow. How you can influence it? Number one, EBIT, increased profitability where we live our lives. Secondly, manage our working capital so that we hold the right amount of stock, our debtors are paying us as quickly as possible, and we manage our creditors in an efficient manner. Lastly, our fixed assets, making sure the fixed assets we buy within our business are income and profit producing. If we buy a bunch of vanity assets, like a new motor vehicle that adds no value, yes, that might make us happy, but realize it's going to punish us on the free cash flow calculation.